Hello, everyone, and welcome back to Mindset Startup Academy's Investor Interview Series. Today's topic is covering logistics and technology investments with our guest, Mr. Benjamin Gordon of Cambridge Capital. And before we get started, just a little bit about Ben and Cambridge. Cambridge Capital is a private equity firm investing in the supply chain sector. Their philosophy is to invest in companies where their operating expertise and in-depth supply chain knowledge can help top management teams grow their businesses. Cambridge seeks to partner with management teams that share their passion for the supply chain sector, whether it's in transportation, distribution, logistics, or supply chain technology. Cambridge Capital was founded in 2009 as the investment partner of BGSA Holdings, one of the most active M&A and strategy advisors exclusively focused on the supply chain sector. Cambridge's relationship with BGSA gives them deep market expertise, transactional capabilities, a vast network of resources, and a powerful core competency in the supply chain sector. Our guest today, Mr. Benjamin Gordon, is founder and managing partner of Cambridge Capital. He draws on a career spent building supply chain and technology companies, and as CEO of BGSA Holdings, Benjamin led the firm's efforts advising on over $1 billion worth of supply chain transactions. And prior to BGSA Holdings, Ben founded the company Threeplex, an internet solution company enabling third-party logistics firms to automate their businesses. Benjamin raised $28 million from blue-chip investors, including Morgan Stanley, Goldman Sachs, Bank Boston Ventures, CNF, and Ionian. And thereafter, he exited Threeplex via a purchase from Maersk. We hope that you enjoyed today's interview. You'll find Ben and Cambridge Capital's contact information sprinkled throughout. Please let us know your thoughts, and let's get started.
The flip side of that is that we see four major areas of optimism. One is e-commerce. As growth in e-commerce ripples through the economy, lots of supply chain companies benefit from that. Two is the growth in niche sectors, and I'll tell you about some of those great niche areas like cold chain technology or temperature-controlled warehousing. Three is the maturation of supply chain technology and some of the outstanding categories producing growth. And then four is the capital markets. So if you like, I can tell you a little bit about each of those topics.
Please, I would love that, please.
So, well, let's talk about the e-commerce side. So e-commerce has had inexorable growth over the last 20 years. And if you look at e-commerce sales, which just to put it in perspective, last quarter, there was close to 160 billion in online sales, which was up from, I think, around 5 billion 20 years ago. And so this steady growth has been not just good for the Amazons of the world, but it's been great for the logistics companies that serve e-commerce. And I'll give you four examples. One is micro warehouses. So what's happening is you used to see these enormous warehouses that companies would build to do fulfillment for their entire network. Well, now you're seeing small warehouses built in local markets so you can do quick same-day fulfillment. So you can build a micro warehouse for 3 months and $3 million for a 10,000 square foot facility. That's a very quick turn. You could be profitable within a year. So big retailers like Walmart, Meijer, Ahold, and Albertsons, they're all trialing these micro warehouses. And that means if you're in that field or providing technology and robotics for that field, you're doing great. A second area is fulfillment. So e-commerce fulfillment companies are growing at 20%. You have giants like Radial, which is a roll-up, and then you have little startups like a Red Stag. What these guys are doing is bringing automation to the logistics world, and that automation can boost margins for logistics companies. Third example would be the last mile. So it's an area of great interest right now because there's so much effort focused on figuring out what happens when a consumer buys something online and there's a local warehouse. How does it get from the warehouse to your house? That's the last mile. That's a $31 billion market. It's growing at 20%. It's driving growth for big guys like UPS and XPO, but also startups like Grand Junction, which we were an investor in, Bring and Delivery Circle, both of which we've also invested in. And those guys are all in positions of growth. And then the fourth is reverse logistics. So what happens when you buy something and it has to be returned? Well, reverse logistics is what that's all about. $95 billion of product was returned after the holidays. That's a 20% increase over last year. It's huge. And that's an opportunity for companies like our friends at Genco, which sold to FedEx for $1.4 billion, and lots of others. So those are four examples of winners that e-commerce is producing.
You reference on there how e-commerce is changing transportation and consumer behavior. And I was going to ask you about that. And I think you might have just touched on it. Could you expand on that point a little bit for me? Because I thought it was incredibly interesting.
Sure. So Amazon is training consumers to expect more. So, Megyn Kelly had the book called Settle for More, which I thought was a great title. And Amazon is training consumers to settle for more. What does that mean? Well, if you're buying something online, you are increasingly expecting instant gratification, right? I bought it today, I expect it today. Well, how does that actually happen? It's all about the logistics behind that. So if you buy something from Amazon, somebody has to provide the warehousing, the fulfillment, the last mile transportation, the tracking to tell you where it is at any point in time, and the reverse logistics so that after you buy it, if things don't work out, how it gets returned. That's a whole chain of supply chain services that somebody has to provide. And what I have found is while Amazon trains consumers to expect that, businesses end up delivering the same capabilities too, because the same consumer that's buying something online is also going to work. And the guy that in turn has a fulfillment or replenishment experience in his business thinks it should be as easy for me at work as it is on the consumer side. So Amazon is just training people to expect a faster cycle time when it comes to everything. And that puts pressure on logistics companies, but it also produces opportunity for people that are good at that kind of quick turn fulfillment. And I think that's a reason why you see companies like Shopify, which bought 6 River for close to $500 million because of the automation and warehouse robotics that 6 River is providing. That's not just for consumers, it's also for businesses. So to me, it comes back to the fundamental point. Amazon is training consumers to expect more, and that produces opportunity in logistics.
When you're looking when you put your investor hat on, Ben, you touched on a little bit earlier, early stage and even into the later stage. Is it safe to assume that middle market is the sweet spot for Cambridge Capital when you're assessing these type of opportunities in emerging sub-industries?
Yeah, Verlin, that's true. We love mid-sized founder-led companies. So mid-sized to us typically means businesses that are profitable, doing anywhere from 1 to 20 million plus of profit and growing at a healthy rate. We're capable of doing early stage, and we did that with Grand Junction, and we're capable of doing larger later stage, and we're looking at a much larger business right now. But in that middle market, where we see thousands of companies in the logistics and supply chain realm, what we find is the entrepreneur who's built a great business but wants help to support getting to the next level tends to find us as a great partner. And the way I think about it is the guy that has a startup still has a lot of risk and uncertainty in his or her business. And the person who's built a large public company or a large private equity-backed company and wants to sell will likely hire a banker, run an auction, and talk to 200 plus buyers. But the person that we love is the founder who might want to sell a stake, but might also want to keep a stake and then want some help in getting to the next level. So my own experience really is what illustrates this. When I started my first company, which was Threeplex, a SaaS transportation management systems company, I had lots of venture capital, private equity, and investment banking firms that called on me. But most of them didn't really understand supply chain. And while they were smart people, they didn't really understand how to help me in a meaningful operational way. And I thought, wouldn't it be great to have a firm that can provide that? So our team today consists of people who have built some of the largest companies in logistics. So people who've played an important role in building companies or divisions of companies or acquired companies that are part now of UPS, FedEx, Kuehne+Nagel, and other giants. And so that means operationally, we can work with great founders, entrepreneurs, and management teams to help them grow their business. It also includes people who have invested in outstanding companies and have deployed over $1 billion in logistics and technology companies. And that means that we can be seasoned professional investors who understand what to look for and how to be good value-added investors. And then you have people like me who are a little bit of everything. I didn't build the billion-dollar businesses that some of my partners have built, and I haven't invested the $1 billion plus that some of my other partners have deployed. But I've been able to be an investor, an entrepreneur, an advisor, and a part of other people's great businesses. And I think collectively it puts us in a position where a great founder can turn to us and say, Cambridge, help me get from outstanding and mid-size to outstanding and large. And that's really the niche that we seek to dominate.
You referenced some primary bookends when you're looking for companies. Can you share with us a little bit about the assessment that you're doing in relation to logistics or technology? So let's say, for example, you have a particular target on the radar. Can you give us an idea of what some of the attributes are of these companies that really sort of fit the sweet spot for you and the team?
Sure. So we look for a few key characteristics. The first is a big market. So in the world of investing, if you're going to spend the time to do the work, you want to make sure the opportunity is big enough. So number one is, are they solving a big problem in a large market? I'll give you some examples. The reverse logistics category is one that we like. That's a multi-billion-dollar business. If $95 billion was returned after the holidays, and that's a 20% increase from the prior year, the logistics opportunity is a piece of that. Logistics spend might on average be 10% of the value of the underlying product. So that's a $10 billion plus market just during the holidays. So is there a large market and a real problem that's being solved? I think that's issue number one. Then issue number two is, does the company have a unique and compelling solution? So, for example, when we looked at Grand Junction, one of the things that we really liked was the founder, Rob Howard, had created a technology, but also a network of last mile transportation companies or couriers. And so he was able to provide a bundled solution, both the technology and the service, to retailers. That meant that when somebody placed an order online, they could automatically punch into the network in order to get this network to handle the last mile for them. So that was, at the time, a unique and compelling solution, and the size of that network provided some differentiation. So do they have a unique and compelling solution, number two? Number three is the leadership. Is the CEO somebody that we believe in? Is he or she somebody who's been successful before and is likely to be successful again? Now, success can be defined many ways. I'm a big believer in the American dream, and I'm a big believer in the fact that we all are able to learn from our mistakes. I've certainly made plenty of mistakes myself, and so I don't expect every CEO to be someone who's built a billion-dollar business before, but I like to know that that CEO has had successes that he or she has learned from, and failures that he or she has learned from too. To me, understanding that narrative is really important, because at the end of the day, we're all human, we're all fallible, and are we coachable? Can we learn from what we did before, and how do we do better? So that all comes into the question of, is this CEO somebody that we want to back? Then I think the fourth question is there a deal that makes sense? You could have the world's greatest company, but if the valuation expectations are twice as high as other comparables, it just doesn't make sense. Our general rule of thumb when we look at a company and an investment is we'd like to be in a position where if we're right, we're going to generate a return that's north of 30% annually and hopefully much higher than that. And that means that the deal has to make sense. So the valuation, the structure, it just has to be fair and reasonable. And then the last question is, can we bring something to the table to help, right? If it's a great business, but at the end of the day, it's not unique to our capabilities, then why do it? So I'll give you an example. When we looked at, well, there's a company that we're in midst of right now. It's an exciting business that is really a technology-enabled logistics company in Latin America. And we happen to understand a lot about tech-enabled businesses because we've been involved in building or investing in several of them. So we look at this business and we think there's pattern recognition, things that we've seen that worked in the US, could those patterns apply here in Latin America? And can we help connect them to other CEOs who've built similar businesses, customers who could adopt, and people who could be part of the team? We'll see, we're not done with all the work yet, but if everything checks out, great. That's an example where we think we can help in multiple areas from a commercial standpoint. So those are the key attributes that we look for. A large market, an important pain point, a unique solution, an outstanding CEO, a deal that makes sense, and value add that we can bring. And if we see those ingredients, we're a fantastic fit and we get very excited.
What we're doing here in Mindset Startup Academy is really kind of getting into the weeds. We talk about a lot of metric and capital-driven capital raises and helping the founders unpack what some of our markers are. Given that we have the luxury of having you today and one of the first interviews where you're touching often in that middle market space, for some of these early founders, I think it's important to sort of be able to understand their capitalization structure over time. We understand the environment in terms of market size and some of the attributes, but one of the things that some of the founders ask a lot of times is how does an investor know that I'm positioned for the necessary future growth? I have the primary ingredients, right? I'm in a big market. I've got a well-experienced leadership team. They pass the qualitative skills test with flying colors. Are there certain metrics or signs once the other primary markers are checked off, Ben, that you feel comfortable that some of these earlier middle stage companies can continue this level of growth in this market size and opportunity that you described?
Sure. Well, to me, it's all about traction, and that comes from customers. Do the customers like what they're doing? Are they referenceable, and are they repeatable? You know, it's funny, in the venture world, you'll hear venture capitalists say, will the dog eat the dog food? And I thought that was an unbelievably insulting way to talk, because that implies that your customers are dogs and your product is dog food. So you will probably not ever hear us say that. I hope you won't. But the key question is just that. Are customers excited about what you're doing? So, you know, how do you know that? Well, number one, you know that because you ought to have customers who are references who say that what you're doing is fantastic, that they want to do more, that they would recommend you to others, and that they are intending to spend more money with you. And that's certainly the most simple and straightforward litmus test. There are other things you can look at. The Net Promoter Score is a good thing to assess, which is basically a quantitative way to evaluate whether customers are likely to recommend you and to have positive things to say. You can look at various key performance indicators or KPIs. Every company's dashboard of KPIs may be different, but to me, it all starts with the customer. You need to have customers that are your biggest fans and by the way, maybe behind closed doors, your biggest critics, but in a way that's constructive and helps you get better. There's a business that I'm about to invest in now, and in advance of making the investment decision, I made an introduction to the company to a large logistics company who's becoming a customer. And that customer has been very generous with their time in telling them what they like, but also what they think is missing, and in turn giving them a blueprint for how to deploy their capabilities to get better. And that's fantastic. So I think that's really a terrific example of what we're talking about. The customer has to be your biggest advocate and also your biggest source of constructive criticism.
One of the things that I'm always fascinated with is the qualitative skill sets. And I always ask the investors at least one qualitative question, because it's one of these things oftentimes, particularly here in the early stage or in the venture space, where no one has a specific blueprint on how they're actually judging the qualitative skill sets. And I think it's important because, Ben, I get questions sometimes from founders that, how should I say this? Maybe a slight bit of insecurity because they've never done it before, right? They maybe don't necessarily have a large university on their track record, but they've just got the grit and the grind. When you talked before about really zeroing in on that founder and believing in that founder, are there certain attributes from a qualitative perspective that complement those quantitative factors you just referenced?
Yes, I think the number one thing that I look for in any founder, I alluded to this before, it's the question of, does he or she have a track record of success? Yeah. Success isn't just measured in dollars. Success could be measured in setting an ambitious goal and striving for it and hopefully achieving it. That could be in the academic setting. It could be in a nonprofit. It could be any number of different areas of somebody's life. But fundamentally, I'm looking for somebody that's trying to do something difficult, working hard, and then figuring out one way or the other how to make it happen. So I think to me, that's crucial. You know, people talk about grit, and it's become trite to say that, but this is a great example of grit. Do you go for something difficult and do you bounce back? You know, the Carol Dweck's book about the growth mindset is a great example of this. Yeah. Growth mindset means you try to do something, hopefully you succeed, but whether you succeed or fail, you measure it by, am I learning and am I getting better? And does that put me in a better position to be successful the next time? And again, that's all part of this headline of grit. So I think that's number one. I think number two is coachability. So, you know, Mark Andreessen has a line that he likes to use about often wrong but never in doubt. And sure, it's good to have a sense of self-confidence and to go for it, but you also have to know when what you're doing isn't working and then listen to that feedback, whether that's from the market or from your own inner voice, and to say, you know what, I got to change course here. So I think that's really important. Coachability is not just if an investor says something that does the founder listen to him or her, which I think is, again, an example of the arrogance that I think many investors have. It's more about, are you receptive to feedback, whether that feedback is coming from the market, from your peers, from an investor or board member or somebody else, and do you process that feedback quickly? And I think that's really important. And then the last thing that I would say is team building. So if you're a pilot, you know that there are two kinds of flying strategies. There's IFR and VFR, I for instrument and V for visual. Well, visual works when you can see everything around you, but you know, at some point you reach a level where you've got to be able to rely on systems. That's where the instrument flying comes in. And it's the same thing with the business. When you've got a small startup, you've got 5, 10, 15 people, you can probably get away with doing everything yourself as a founder. But when you're running a mid-sized company, a company with some scale, 100, 200, 300 or more people, doesn't work anymore. You've got to figure out how to manage through people. That means you've got to be great at recruiting people, you've got to be great at motivating them, and then you've got to be able to delegate and let them take off in their respective fields. That's a really hard skill. I don't claim to be very good at that myself. And so I think it's much easier said than done. But to me, those are the three fundamental qualitative skills that I look for when it comes to evaluating great founders. Do they have grit? Are they coachable? And are they good at transitioning from doing it themselves to being able to manage and motivate through people?
we have a lot of founders in this community that have successfully completed their pre-seed round. They are now getting ready for a seed round. There's a lot that have successfully completed seed and getting ready for a Series A. Some of the questions and topics that we get, this is why I love these interviews, because we get to ask folks like yourself and provide these feedback for the community, is, what are some of the things that these early stage founders can do today to help their odds of achieving middle market? And I think where this question is kind of coming from in so many different types of ways is that some of these founders are really doing well in the very early stages, but once they've really proven that product market fit and they're now getting ready to scale, how do you move from 10 to 1,000 or 2,000? There's certain, I don't want to say hesitancy, but they really want to make sure that they're positioning themselves properly, not only to sustain in the middle market, but they feel that oftentimes the middle market investor space could be slightly different. I feel like I've really gotten to know and understand the early stage market. What are the middle markets going to be doing? So are there certain best practices, either from your own experience or that you see in the portfolio companies, that early stage founders' best practices, if you will, can be doing now to give themselves that best shot should they have that fortunate ability to get into the middle market status one day?
Sure. So right now I'm an investor in a company that we did invest in early on when it was a very, very small business. The company has grown about 15x in the last 4 years, which is fantastic. And they're in the middle of doing a financing right now at a multi-$100 million valuation. And what did those guys do right? And what are some lessons learned as a company, in that example, goes from early stage to mid-sized, or you might argue large? This is a business that could be a billion-dollar value business in the next year or two at the current trajectory. So what did they do right? Well, I think number one is they put in place systems at an earlier stage that resembled what you might see for a larger later stage business. So if you look at the metrics that business has, you look at their dashboard. The dashboard has a clear picture of their pipeline, their product roadmap, their customer key performance indicators, and a set of other metrics that you might look at the metrics that they had when they were a sub $10 million business and think, well, gee, why are you going to that trouble? Why are you doing that? Well, it's because you're playing backwards from where you want to be 1 year, 2 years, 3 years out from now. So I think part of it is you put the metrics in the dashboard in place. Two is you hire in front of where you are today. You hire for where you need to be. Great example of this would be Brad Jacobs at XPO. When XPO got started, Brad developed a plan and then went and bought a company called Express One. The business was doing around 10 million of EBITDA. He bought the business for a little over 70 million, and so around 7 times EBITDA. But he did it in an unusual way. He put cash on the balance sheet of the company, which was already public. He didn't buy it and take it private. He didn't use bank leverage or anything else. And that in itself was something that people thought was unusual. And then he did something else even more unusual, which was he went and hired all these people, and he promptly took the business from a $10 million EBITDA business to a cash flow negative business. So why would he do that? And a lot of people scratched their heads and questioned it. But what Brad was doing was building a business so that he would have the people in place for where he wanted the business to be 3 years later. What Brad consistently said was, today the business is small. It's a $10 million EBITDA company that's about to become cash flow negative, but I'm planning for when the business is over $1 billion of EBITDA. Well, people thought that was crazy, but guess what? Today, that business is more like $2 billion plus of EBITDA and has an enterprise value in excess of $16 billion. So in hindsight, it looks great. It looks like a linear path, but go back and read what people wrote in 2011. It was not the same thing. So I think plan for the future and put the people and the infrastructure in place to get there. I don't recommend that for everybody. You take your business from cash flow positive to deeply cash flow negative, but plan for the future and put the people in place that will take you to the business of 5 years from now, not just today. And then the third thing is and this is important, you got to practice what you preach. So, if you look at the way most people running a small business think about it, maybe they're taking money out if they've got a mature business, or maybe it's a startup and they raise money and they pay themselves a salary, and that's fine. You're entitled to do those things, but think about the message you send when you say, you know what, I'm going to take zero for a salary, and I want to tell the people that I'm recruiting that they should be joining for the same reason why I'm in it, which is because I believe in the growth and I believe in the equity. When I started my first company, I took a nominal salary, and I could have taken a much larger salary, but it allowed me to recruit, for example, a CFO who had come out of Sealand, a multi-billion-dollar business, who could have attracted a seven-figure salary, and instead took a nominal salary as well because he was in it for the same reasons I was in it. And so that kind of alignment for long-term value creation is crucial. So those are three things that I think a founder of an early stage company can do to plan for being late stage.
Well, perfect. Well, Ben, before I let you go, because I know we're coming up on our time limit with you, and we've covered so many of these good topics, I always like to finish with the investors in these interviews to say, in relation to logistics and investment technology and all aspects of supply chain and all the other pieces, what are some of the things on the horizon that makes Ben most excited about this industry?
So I'll tell you this. The things I'm most excited about are not necessarily identical to the things that I'm investing in. I'm going to tell you about both, because what I'm most excited about is the huge disruption that technology and smart supply chain entrepreneurship is causing throughout the industry. Things like self-driving cars, the electrification of the supply chain, robotics, automation in the warehouse as well, drones. One thing that's amazing, by the way, amidst this coronavirus epidemic that's gripping China, there's been a tremendous investment in drone technology, because if you have drone delivery instead of human delivery, guess what? You eliminate one of the risk factors. So the things that are happening on the technological side of supply chain right now are unbelievably exciting. Having said that, the things that I'm investing in, it includes some of those themes, but it also includes businesses that are taking something proven and just doing it a little bit better. And so I'll give you an example of that. Right now, we're looking at a terrific company in last mile logistics, and they're just figuring out how to add some automation to their existing business. So is this a company that will show up on the cover of, I don't know, Bloomberg as the most revolutionary technology that's rippling through the industry? No, but sometimes applied technologies in a services business can be maybe a little bit less sexy, but a lot more successful. So there is risk and uncertainty in betting on the next big self-driving car technology, but I feel very confident about investing in a great logistics company that's an early adopter of technology to be able to do a better job of deploying their business. So to me, tech-enabled logistics businesses, whether it's in last mile, warehousing, fulfillment, reverse logistics, or other supply chain services, those are all great areas of opportunity. We're really excited about them. We think it gives us an opportunity to invest in proven businesses that can use technology to become that much higher growth, higher margin, and more successful. And by combining what those companies have with the help that we can bring in terms of experience scaling businesses, knowledge of technology, and ability to be helpful to entrepreneurs on multiple fronts, really that combination is what I'm most excited about.
Fantastic. That was a great description. Well, Ben, that was a fantastic interview. I loved all the insights. It's going to be incredibly beneficial for the community. So on behalf of all of them, thank you so much for doing the interview with us today. It was an absolute pleasure.
Erlen, thank you. It was great to be with you.
Thank you. So thank you everyone for watching. And as you've seen through the video, Ben and Cambridge Capital's information and website information is up there, so you can feel free to utilize that. Thank you so much, everyone, for watching, and we'll see you next week.